Hey traders, this is Christian from Hertz, Tribeca Trade Group with your market view for the week. This is our market view and what I'm looking at for the week, what we got going on, and as well as technicals for the week. So first thing I want to talk about is what are the main events for the week? Well, in U.S. economics, we've got consumer confidence, new home sales, durable goods, and GDP. So those are the things to watch for the week. This is the actual calendar. You can see it's kind of backloaded in terms of events. We have the durable goods. We've got new home sales report coming out Wednesday, durable goods coming out Thursday, GDP coming out on Friday. So GDP will be interesting, but it is a lagging indicator. But nevertheless, people will be focused on it. We'll be talking about it on CNBC. What was the last quarter? So what I find a bit more interesting, and I think what is going to take center stage for the week is earnings. So we have, I think it's 171. I have it in my newsletter. 171 companies in the S&P 500 are reporting this week. So this is actually the busiest week for earnings coming up, and we've got some heavy hitters coming up. I have the NASDAQ because it looks like there's a lot of NASDAQ companies that are reporting. And we've got Apple. That's Tuesday afternoon. That comes out always a half hour after the close. So that'll be Tuesday. We've got a bunch of other technology companies coming out. Texas Instruments, a couple of semi names, Western Digital. Tesla also reports next week. We've got a couple of the big biotech companies. Biogen reports, Celgene, Amgen. And then these little companies called Google, Alphabet, and Amazon, small companies. Just kidding. I think everybody's waiting for those two companies to report. We've got, it's been kind of a mixed quarter so far for earnings, right? I mean, it really depends on what sector that you're looking at. Industrial's very weak so far. GE, Honeywell, the likes of those companies, and then you get more of your FANG technology companies, Netflix, Microsoft having really good quarters. So again, really have to be in the right groups, and I'm going to delve a little bit more into that. But first of all, what have we been seeing here in this market? We've been seeing last 4 weeks of where the S&P has not moved greater than or less than 1% for a week. So very much a sideways market that's going on right here. A lot of price digestion. To me, this kind of makes sense. We're right smack in the middle of earnings season. A lot of investors, analysts want to see how this quarter is going to shape up. And then we also have this little thing called the election that's also just weighing over the market. November 8th is election day, so we've got about another week and a half, 2 weeks, I guess, before we can get rid of that. But those that big overhang over the market just basically says, hey, the market doesn't really want to move too much here. And if we go to some technical levels here, 2117 is a level that I've been watching for the last couple weeks. This is really your major support. This is on the weekly chart. I always start at the weekly chart and then draw in closer. But you can see for the weekly chart, we've been in this upward trend, but we're getting really, really close to breaking the upward trend. We're holding in. So 2117 is about 19 handles from where we are. So we do have a little bit of bumper room for this particular area of 2117. That's the area that we really need to hold on to. Why is that important? Because it's the yearly value area. This is the uptrend that we've been in. However, if we fall into this level, which we have a couple times here in the past, and we've held it. So that's what I'm really watching, and that's your main level to watch. Drawing in a little bit closer, you could see that we're right on this upward trend line. Where does this upward trend line originate from? From back here, so a long ways. And we've slipped below it a couple times, but we've had some nice kick saves. Thursday, Friday ended up being, we've closed right where we opened. So this just tells you to me, if we're closing exactly where we opened, we've been going a little bit lower here. It tells me that there's a lot of indecision in the marketplace right now. Also, keep in mind with earnings season, not only do you have indecision, but those big buyback programs for your big blue chip companies, your larger companies that have these buyback programs, those are all in their quiet periods as they report for earnings. So the companies cannot continue to buy back shares once right around when they're supposed to report earnings. So this happens, and if you take a look back, the last earnings cycle, which was at the end of July, beginning of August, what did we do there? Kind of similar looking candles here, but very much sideways action until we got out of the way of that. And again, just for the market not being able to close on the highs, just tells me that those buyback plans there's no oomph in the marketplace. So once those come back online, I think we've got a chance for the end of the year. One other chart that I want to go to, the VIX. The VIX got up to about 18 a couple weeks ago, and it's been doing nothing but come in a little bit. So, I really think we could be gearing up for a nice end of year rally, but we're not out of the woods yet. I think, like I said, analysts, investors want to see how the rest of the earnings season is going to shape up. Again, we're just kind of getting in the middle of it. And then finally, once we get post-election, I think there'll be something to do there. All right, so what else is this market telling us? One of the things that it's telling me with the S&P not moving at all the last few weeks, there are areas of the market that are moving. And if you look at implied correlations, they're at a 2-year low. Why am I looking at implied correlations, or what's interesting about this? It basically tells you whether or not stocks are moving together, if they're moving as a group together, or if they're not. And what this chart tells us is what the JCJ implied correlation index is telling us is that stocks are not moving together. You have some stocks moving up, some stocks moving down. If you look at over the last 3 months, for example, what some of the leaders of the stock market have been doing, you look at oil and gas explorers and producers, that's XOP, that's up 11% over the last 3 months. Semis, SMH, up 10%. Banks, up 8%. Then you look at the other side, gold miners down 14%, home builders down 10%, utilities down 9%. So just the conclusion of why I'm looking at implied correlations is because it tells you what kind of market you're in. You want to trade the market that you're in, and not hoping for something else. And I've said this all year long as implied correlations have been trending down. We're not in a market where you can trade indices. S&P it's basically it's churning here. We've moved basically nowhere all year long. However, there's a lot of opportunities between sectors. So if you have a long short book, that is most ideal, I think, right now for this market. It's a stock, and the final conclusion is it's a stock picker's market. I think you can be long certain names that are up on uptrends, strength names, and you could be short names that are in a downtrend. So I want to dig into that a little bit more. The last couple of weeks in the newsletter, I've been examining what the S&P sectors have been doing. In the last couple of weeks, I've been noticing a deterioration in sectors in respect to their moving averages. We've got a couple sectors that are above the 50-day moving average. We've got a lot of sectors that are between the 100 and 200-day, the 100 and 200-day moving average, which in my opinion is kind of neutral to weak. And we've got a lot of sectors that are under the 200-day moving average, which is straight weak. So it's changed. The only noticeable change from last week to this week is financials reclaim the 50-day moving average. So this is your strength, tech, energy, financials. Big chunk of the S&P, 21%, 13% are the financials. So this is the strength. This is where you want to be. You want to be in the uptrends. And then you can kind of dig in further and you can say, I want to be in the individual names that are in the uptrends. Where I don't want to be in, or where I want to be shorting or possibly going short, is the defensives right now. They're all backing away. Healthcare, consumer staples, IYR, utilities, all of these defensives are now underneath the 200-day moving average. Telecom is close. Telecom actually might be moving below. That might be next to watch to go underneath the 200-day moving average. But the other takeaway from looking at this and looking under the hood of the S&P 500 is it's your risk-on sectors that are moving and that are strong and that are in the uptrend. So this is not so much of a negative aspect of the marketplace. And I'm going to give you another example of, there's a really big trade on Friday, which I'll go into in a minute. But the conclusion of this is that I want to be in sectors, and I want to be playing, investing what the market is giving me, and taking advantage of what's going on here. So as those S&P correlations that are 2-year low, I want to be cognizant of that, and I want to be investing in stocks that are moving up and are in uptrends. Finally, the last takeaway is, I do think that there's a lot of money on the sidelines waiting to be deployed, and I think, if you follow option activity or aggressive call buying, you're going to, if the buyers start to step in here, you're going to see it. I don't think you want to be the first one into the market here. So if you're following option activity, it's going to be right in front of your eyes. You're going to see the aggressive call buying. You're going to see sweeps. You're going to see a lot of calls being bought and aggressively. So why I'm maintaining a big cash balance right now is I think we need to get through earnings season. We need to get through the election, and then I want to see what people are buying, what sectors, what areas of the market people are buying. So that's my take on the market. In the newsletter, I highlight names that are moving, areas of the market that have been strong the last week. Certainly the steel group, which I'm going to go into detail about the steel names and what we're seeing in terms of option activity. FANG stocks, FDN is the ETF here. That's the Internet ETF. Banks very strong, and home builders were weak. Telecom stocks also weak. Industrials were also weak. And international countries, Brazil continues to chug along, up 5%, one of the best performers in international markets. So what did ETF fund flows say for the week? Well, the last couple weeks, overall equity flows have been completely flat, but they started to pick up towards the end of last week. We actually saw $3 billion of inflows for the week last week. And again, most of this was Thursday and Friday. And what was the general theme of these inflows? Very similar to what we saw with looking at moving averages and sectors. It's risk on. Where did the money go to? Financials, $516 million for the week. Inflows went into this group. XLF, KRE, IYF, those are the names in that group that saw inflows. And technology saw a little bit of inflows as well. Semis, which I think is positive. SMH, the chips saw some money come back. They were an underperformer about 2 weeks ago. They saw a little bit of money left the group. So this week it came right back in. So these were not monster inflows, but still, I think on the right side of the equation, more riskier sectors. Where did the money come out of? Huge money. Now this is more interesting to me. Just a lot of money coming out of these defensive groups. Consumer staples, $630 million that left that group. REITs, I've been kind of jumping up and down about this because there's just been huge money that's been coming out of this group. So last week, $463 million left REITs. For the last 3 weeks, it's been just monster outflows, $2.6 billion out of that group. Names like IYR, VNQ, and one of the newer ETFs, XLRE, which was actually led outflows last week. Also, utilities continue to see outflows. In international areas of the market, nothing else to really say here except, or I should say, the big standout continues to be emerging markets. Now, 16 straight weeks of emerging market inflows, 667 million last week, but they just continue to chug along. And what's notable, or what's particularly interesting, is the U.S. dollar has been gaining steam the last couple weeks, which is usually a negative for emerging markets and those particular countries. But you don't see the investors, haven't hesitated or haven't stopped going into emerging markets because of the stronger dollar. So really strong here. And then finally, the last takeaway in international ETFs is Europe, Japan. These two areas have seen just monster outflows for all of 2016. What I've been noticing is for the last month or so, the outflows have really tapered off. So there isn't a lot of money that has been, they haven't seen inflows yet, but at least they've stopped seeing huge outflows. And if you've been reading my newsletter from week to week, and I've been detailing this, back from, I'd say, January to June, every week there was around $1 billion between the two that we're seeing outflows. So we're not seeing that as much. You could see for the week, Europe still did have outflows, but again, they're not $1 billion. Okay, so that's ETF inflows and outflows. Again, the theme of that is same type of thing as the S&P. Hasn't really been moving too much. There hasn't been too many inflows, but started to see it towards the end of last week, and especially in risk-on sectors. Okay, so I'm going to get to EFA. Well, I might as well go through EFA right now. So first of all, what is the EFA ETF? This is the ETFs of the week section. Every week I highlight about 4 or 5 different ETFs that I think are really interesting, compelling names in terms of technicals and flows that we're seeing. So what is EFA? It's it's international developed markets, so it's mainly Europe and Japan. It just has a fancy name for it with EFA, but that's essentially what it is. There was a sizable option order last week. This was Friday actually. 41,500 January calls went up here. That's about $1.5 million in premium. So interesting trade there, sizable trade. This particular investor, this trader, is expecting about a 5% move by January expiration. If you look at the chart in EFA, it's basically been going sideways. There's been no reason for me to really own or be involved in this group at all. But there's a tradable low there's a tradable area of support that you can use here. This is the weekly value, or excuse me, the weekly chart, the yearly value area, and that's 57.64. So kind of interesting here. If you're looking to take a shot at that, I would use that support of 57.64 to possibly go long. Again, $60, $61 is right here, right about the point of control. So I think that's definitely possible by year end. And this is what I wanted to focus on. I would say almost the theme of this video and my weekend newsletter is kind of rotations, right? I mean, this is really interesting. On Friday, a lot of people aren't too familiar with these ETFs, but SPHB, that's your high beta ETF, and it saw a sizable block print in cash. This was about midday on Friday. There was just about 1.1 million shares were bought. This was aggressive. This was a sweep, just like you see in option trading. IS means interdealer sweep. So they traded this above the ask. It was aggressive, about a $35 million trade. And they went into high beta securities. If you look under the hood in this ETF, the high beta ETF, it's mostly technology, semis, banks, biotech names. So they rotated into high beta. What did they rotate out of? Well, there's this very similar print happened just around the same time. Very similar size, about $35 million trade in SPLV. What is SPLV? It's low volatility securities. Basically your defensives, your utilities, your consumer staples, your telecom stocks. So very risk on trade here. Someone's positioning themselves. They're getting out of those low volatility areas that have performed very well in the beginning of the year when interest rates were very low. Now interest rates are starting to move up. So investors are getting out of these types of securities, SPLV, and going into high beta. Don't hear too many people talking about that trade, but very interesting, happened midday on Friday. Another area of the market, very interesting, that was in focus last week was steel, which outperformed really well last week. We saw 2 very interesting trades. The first one happening on Wednesday, sizable trade in U.S. Steel, X, 10,000 contracts going all the way out to April 24 calls, $1.2 million in premium. So somebody putting down a pretty decent sized chip here, thinking that the U.S. steel companies go higher here. We did very well with trading this in the Tribeca Trade Group room. I traded this on Wednesday. I got out of it at the close on Wednesday. U.S. Steel actually retreated a little bit after a huge day on Wednesday. It was down 2%. I bought it on the dip, sold it again on the close. Same thing on Friday. Started the day lower, took advantage of that, and I'm still long a little bit of X. Another name that I got into and added to a position was MT, another steel name, not quite as far out as April, but December call buying, December 7 calls going up. Not nearly as big as the U.S. Steel name, but 700,000. This tells me somebody's after steel names here. So there is a steel ETF that's out there. It's SLX. This is the weekly chart of SLX. Steel names have been some of the best performers year to date. If you notice that it's actually taken a little bit of some price digestion here the last couple months. So it's now turning back up. The Raptor indicator also almost firing off a buy signal here. And I think 34.97, which is the top of value for the year, is something that's definitely achievable, especially seeing the aggressive call activity. The next area of the market that I'm looking at, which had a great day and had a really nice week, especially with the S&P flat on Friday. The FANG stocks, FDN, and again, the FTN is the Internet ETF. The FANG stocks are the largest weights in this particular ETF. Really strong performance on Friday, up 1.8%, helped by Netflix. Huge outperformer after earnings, as well as Microsoft, as well, which had a really nice earnings report as well. So that group jumped on Friday. If you look at the chart, you can see this group is in a really nice uptrend. You've got those two names that report later in the week, Amazon and Google. So it will be really interesting to see how those report. If you don't want single stock exposure, or don't want to play the options because of the increase in implied volatility going into earnings, I would look at the FTN ETF. Again, they have the biggest weight. The FANG stocks have the biggest weight in there, and you're a little bit more diversified. And then finally, the last area of the market that I wanted to look at was consumer discretionary. Consumer discretionary, not an area of the market that I've been in, not an area of the market that I've wanted to be in, because it's been in a downtrend, and it's really underperformed the last couple months. This chart looks a lot different than the S&P, which has been moving sideways. This is actually has fallen down a little bit more and has been sideways for the last week. So it got a nice. This also got a nice boost on Friday. A lot of this was because of the speculation of a merger between Time Warner and AT&T this weekend that was formally announced between the two. They are looking to join. And Friday, because of the merger, all of the media names really got a boost. You can use the saying, a rising tide lifts all boats. So all of the media names, Disney, Netflix, Fox, CBS, all were up huge on Friday, which is to be expected when a merger of that size is announced. But also what I found particularly interesting was some of the other names in the group. You look at Lowe's, Target, Yum. Those also had a really nice day as well, even though they have nothing to do with media. But you look at Lowe's and what the price, this has been another stock that has just been in a horrible downtrend. Zoom out, I'll show you. Since it reported earnings, it gapped down and has just continued to fall down here. But buying stocks on the dip after they're done with their sell-off, maybe something something that I'm looking at here in this particular group. And if you look at the activity on Friday, you could see this was basically a 45 degree angle up and to the right here. So interesting that these stocks started to wake up a little bit. And maybe most of the damage is done in this group. So that's what I'm looking for. Let me just switch from Lowe's to XLY. And a level to watch in this consumer discretionary ETF is called this red line here, which let's call it $80 here. So if we can get above the top of value in consumer discretionary, I think it'll be interesting. And a lot of these names have not reported earnings as well, so it'll be interesting. They could be names to buy in the dip here if a couple of them have strong quarters. This could be a kind of an unloved name group of stocks to get back into. And then finally in the newsletter, we have stocks to watch, which you have to be a paid subscriber of Tribeca Trade Group to get involved and to see our individual stocks that we're watching for next week that we have catalysts for. So, which brings me to our website, TribecaTradeGroup.com. You could see, all of our blogs and videos on here. We recently put out a trade idea on Alibaba for the Singles Day event that's coming for November 11th, 11/11. So we have a trade idea for that. And, I would love for you guys, if you like this type of video and you like our analysis, we do a lot more in detail in our trading room, in our options trading room, which starts every day at 8:45 Eastern. We spend 45 minutes and take a look at all of the macro indicators, the commodities your currencies, and we see what's most important in the market every day. And then we drill down to individual names, look at upgrades, downgrades, and names that are on the move, names that we want to focus on. So we do that every day in the trading room. And here's what we're currently offering. You can check us out. You could try us for half off the first month. That's the senior trading desk package. Monthly, it's regularly $199 per month. You can get involved for half off the first month, so $99 for the first month. Check it out. I think you're really going to like it. If you like these types of videos, please do check us out. The coupon code for that half first month is TTG LD, so Larry David. So please get involved here and enjoy the rest of your Sunday. Thank you very much for watching the video, and get back to watching some football. Have a great day. See ya.